When I buy a stock, I don't see a ticker symbol flashing on a screen. I see a business. I see employees coming to work on Monday morning. I see customers choosing one product over another. I see suppliers extending credit because they trust they'll be paid. And I see managers making decisions that will echo years into the future. That's what you own when you buy a share. Not a piece of paper, not a line in a brokerage account, but a fractional interest in a living, breathing enterprise. The market, of course, doesn't present it that way. It presents you with prices that blink every second. It presents urgency. It presents opinions. It tempts you to believe that motion equals progress. But ownership is not about motion. Ownership is about judgment. If you owned 100% of a small manufacturing company in your hometown, you wouldn't ask what someone would pay you for it every 5 minutes. You would ask, are we serving customers well? Are we earning more on the capital we deploy? Are we strengthening our competitive position? That is the mindset I want you to carry. Today's economy feels loud. We have policy debates, trade tensions, election cycles, interest rate speculation, and commentators who can turn a routine quarterly report into a national emergency. It's easy to think the value of your holdings changes as quickly as the volume on a television panel. But the intrinsic value of a good business moves far more slowly and far more predictably than the market price attached to it. If a company has a durable advantage, a brand customers trust, a cost structure competitors struggle to match, a network effect that grows stronger with scale, then its long-term earning power is what matters. That earning power is driven by fundamentals, return on capital, margin stability, reinvestment opportunities, and management discipline. Those variables don't swing wildly because of a speech in Washington or a headline on social media. They evolve based on decisions made inside the company and the strength of its competitive moat. When I evaluate a business, I begin with a simple question. If the stock market closed for 10 years, would I be comfortable owning this enterprise? That thought experiment removes speculation. It forces you to focus on what the business will produce in cash over time. Cash is not political. Cash does not care about opinion polls. Cash is the result of serving customers in a way that leaves them satisfied enough to return. You will notice that the most successful long-term businesses rarely depend on a single favorable regulation or a single political figure. They build resilience. They diversify suppliers. They strengthen customer relationships. They maintain balance sheets that can withstand shocks. In short, they act like owners who know the world is unpredictable. That is the kind of enterprise I want us to partner with. There is also a human element. When you buy into a company, you are entrusting capital to management. You are relying on their judgment. I look for managers who think like owners, who allocate capital carefully, who avoid unnecessary debt, who communicate candidly, and who measure success in decades, not quarters. A great business with poor capital allocation can squander opportunity. A good business with disciplined management can compound quietly for years. Now let me address something that often tempts investors. The belief that you must react to every macroeconomic shift. Interest rates move, currency values fluctuate, policies are proposed and withdrawn. These events matter, but they rarely overturn the core economics of a truly exceptional business. A company that can raise prices modestly without losing customers has power. A company that earns high returns on tangible capital has flexibility. A company with loyal customers has insulation. If you find yourself checking the price of a stock daily, ask whether you would check the appraisal value of an apartment building you fully owned every day. Probably not. You would be more interested in occupancy rates, maintenance costs, and rental income. Public markets give you liquidity, and liquidity is useful, but liquidity should not dictate your thinking. The availability of a quote does not require you to act on it. There is a difference between volatility and risk. Volatility is what the market displays. Risk is the probability of permanent loss of capital. When investors confuse the two, they make poor decisions. A falling price can represent risk if the business is deteriorating. But a falling price in a stable, well-managed enterprise may represent opportunity. The key is understanding the underlying business well enough to distinguish between the two. In periods of political tension, markets can behave as if the entire economic system hinges on a single event. History tells a different story. Economies adapt, businesses adjust, entrepreneurs innovate. Over time, productivity and human ingenuity tend to move forward. I have lived through wars, recessions, inflation spikes, financial crises, and technological revolutions. Through all of it, well-run businesses continued to generate value. That does not mean you ignore the environment. It means you weigh it properly. If a new tariff increases input costs, does the company have pricing power to offset it? If regulation changes, does the business model remain viable? No, these are analytical questions, not emotional ones. They require calm thinking. They require understanding your circle of competence, knowing what you truly understand and what you do not. Your circle of competence is more important than the size of your circle. If you deeply understand consumer staples, you do not need to opine on semiconductor fabrication. If you understand insurance underwriting, you do not need to chase the latest technological trend. Staying within your circle reduces mistakes. And in investing, avoiding large mistakes is more important than chasing extraordinary gains. Compounding is powerful, but it is also fragile. It works best when left undisturbed. Every time you trade impulsively, you interrupt compounding. Every time you pay unnecessary taxes or fees, you chip away at returns. The simple act of holding a quality business for a long period can outperform more active strategies precisely because it allows the mathematics of compounding to operate uninterrupted. Let me also emphasize temperament. You do not need a high IQ to succeed as an investor. You need emotional stability. You need the ability to remain steady when others are euphoric and when others are fearful. Markets will test you. They will offer you bargains when you feel least comfortable buying and tempt you to overpay when optimism is universal. Your advantage, if you cultivate it, is patience. In the end, buying a business rather than a ticker symbol aligns you with reality. It forces you to think in terms of productivity, competitive advantage, and cash flow. It reduces the influence of daily noise. It turns investing from speculation into partnership. If you remember nothing else, remember this: the market is there to serve you, not to instruct you. It offers prices. It does not offer wisdom. Wisdom comes from understanding what you own and why you own it. When you anchor your decisions in the economics of real businesses, you gain a durable edge, not because you can predict the next headline, but because you no longer need to. Over time, the scoreboard that matters is not the one flashing in real time. It is the accumulation of earnings, reinvested wisely year after year. Own businesses that can do that and let the tickers take care of themselves. One of the greatest advantages you can give yourself as an investor is the ability to ignore noise. Not because the world is unimportant and not because policy or politics do not matter, but because reacting to every sound is a reliable way to lose focus. Markets generate noise the way factories generate heat. It is constant, it is unavoidable, and if you stand too close to it, you can get burned. Every day there is something new to worry about: a central bank decision, an election poll, a trade dispute, a regulatory proposal, a geopolitical flare-up. The financial media will present each development as urgent, as decisive, as something that demands immediate action. But investing is not a game of reflexes. It is a game of judgment. If you allow your decisions to be driven by headlines, you are outsourcing your thinking to the loudest voice in the room. That is not a durable strategy. Headlines are designed to capture attention, not to measure intrinsic value. They compress complex issues into dramatic narratives. Businesses, on the other hand, operate in layers: supply chains, customer relationships, capital allocation, cost controls. These do not change meaningfully because of a single news cycle. The key is understanding your circle of competence. I have always believed that knowing what you do not understand is just as important as knowing what you do. You do not have to be an expert in everything. In fact, trying to be one is dangerous. The world is too complex. Instead, focus on the industries, models, and economic drivers you truly grasp. Stay there, operate there, build confidence there. Within your circle of competence, you can evaluate businesses with clarity. You can judge whether a company's competitive advantage is durable. You can assess whether management is allocating capital intelligently. You can determine whether margins are sustainable. Outside that circle, you are guessing, and guessing dressed up as confidence is still guessing. Noise becomes especially dangerous when it tempts you outside your circle. A hot sector emerges. Prices rise quickly. Commentators declare a new era. Suddenly, investors feel compelled to participate, even if they do not understand how the companies generate cash or what risks they carry. That is not investing. That is performance anxiety. When you stay disciplined, you accept that there will always be opportunities you miss. That is perfectly fine. The market is not grading you on participation. It is grading you on results. You do not need every good idea. You need a few understandable ones executed well. Let's talk about temperament again, because ignoring noise is less about intellect and more about emotional control. When markets fall sharply, fear spreads faster than facts. Investors begin to extrapolate worst-case scenarios indefinitely into the future. They assume temporary conditions are permanent. That is when discipline matters most. Ask yourself, has the long-term earning power of this business truly changed, or has sentiment changed? Those are very different things. Sentiment can shift in hours. Earning power shifts over years. If a company sells essential products, maintains strong customer loyalty, and operates with a conservative balance sheet, a temporary macro shock may not impair its intrinsic value significantly. But the market price may drop anyway. The same logic applies in reverse during periods of excitement. When optimism is high, investors often project rapid growth far into the future without demanding evidence of durable advantage. They assume favorable conditions will persist indefinitely. That assumption is rarely correct. Cycles turn, competition intensifies, margins compress. Your defense against both fear and euphoria is process. Have a checklist. Know what you require before you invest: understandable operations, durable competitive advantage, honest and capable management, and a price that provides a margin of safety. If a situation does not meet those standards, pass. There is no penalty for inactivity. You will also notice that many macro predictions conflict with each other. One expert forecasts inflation, another predicts deflation, one expects rapid growth, another foresees recession. If you build your portfolio on macro forecasts, you are betting on your ability to predict complex systems influenced by countless variables. History suggests that even very intelligent people struggle with that task. Instead of forecasting the weather, build an ark. Own businesses that can withstand various conditions. Companies with strong balance sheets, flexible cost structures, and pricing power are better positioned to adapt. You do not need to know exactly how the next year will unfold if you own enterprises capable of adjusting intelligently. Protecting your circle of competence also means protecting your time. Time is your scarcest resource. Every hour spent chasing rumors or reacting to social media speculation is an hour not spent studying annual reports or understanding industry dynamics. Depth of knowledge compounds just like capital does. Shallow attention produces shallow results. There is a quiet advantage in simplicity. Complex strategies often create the illusion of control. Investors feel sophisticated when they respond to intricate signals or elaborate models. But complexity can obscure risk. If you cannot explain in plain language how a business makes money and why it will continue to do so, you probably do not understand it well enough. The market rewards clarity over cleverness in the long run. Another point worth remembering: activity is not the same as productivity. The financial industry often equates movement with progress. Frequent trading generates commissions, discussion, and excitement. But from an ownership perspective, unnecessary activity can erode returns through taxes, fees, and mistakes. Sometimes the most intelligent decision is to do nothing. Doing nothing is difficult when noise is constant. It requires conviction. Conviction comes from preparation. If you have studied a business thoroughly, if you understand its economics, and if you purchased it at a sensible price, short-term volatility becomes less threatening. You know what you own. That knowledge creates calm, and calm is a competitive advantage. The broader economy will always face uncertainty. Political cycles will continue. Policies will shift. Technologies will disrupt. But within that evolving landscape, certain principles remain stable. Consumers seek value. Businesses strive for efficiency. Capital flows toward productive use. Human ingenuity continues to solve problems. When you focus on these enduring forces rather than transient noise, you align yourself with long-term progress. I'm not suggesting indifference. I am suggesting proportionality. Pay attention to developments that materially affect the businesses you own. Ignore the rest. Distinguishing between the two is a skill, and like any skill, it improves with practice. If you ever feel overwhelmed by information, simplify the question: would you be comfortable owning this entire business if the stock market closed tomorrow? If the answer is yes and the economics remain sound, then temporary market turbulence should not dictate your actions. Remember, markets are designed to transfer money from the active to the patient. Patience is not passive. It is disciplined restraint. It is the refusal to let external noise override internal analysis. Stay within your circle. Protect it. Expand it slowly if you must, but only through genuine understanding, not enthusiasm. The world will always be noisy. Your advantage lies in remaining steady when others are distracted. Over time, clarity beats excitement, discipline beats impulse, and the investor who can sit quietly while others shout often ends up with the last word. Not because he was louder, but because he was right.